Peter Schiff is joining me from Euro Pacific Capital. Great to have you on. As always, Peter, I want to talk everything with you, not just gold today. So let's start with the markets and follow on the discussion that we had with the gentleman. What do you think is going on here?
Well, I think the markets are still in denial with respect to the underlying weakness of the U.S. economy. But I think the reason the markets have rallied off their February lows is because it's now apparent, and it should have been apparent earlier, but that the Fed is not going to be raising interest rates many times, if at all, in 2016, despite comments earlier today from Lockhart that he thought the Fed might raise rates 2 or 3 times this year. I really doubt that we're going to get anything more from the Fed in the way of rate hikes. I still think that we're more likely to get a rate cut.
Okay, yeah, I'm not going to argue with you. Definitely the Fed taking a position, backing off here. And there are a couple of key opportunities where they will have the chance to act. But, of course, it's an election year as well, so people are getting a little bit more skeptical about it. Basically, do you think that 2016, are you sort of writing it off in terms of no Fed action, market goes higher?
Well, I think there will be some action, but it might be an admission that the economy is much weaker than they originally believed and that they're going to come back with more stimulus, either a rate cut, a combination of a rate cut and relaunching of quantitative easing. So I think that's what's happening. I think absent that, I don't think the market does go higher. I think the only way the market goes higher is with a lot of help from the Fed.
Okay, so you think there's going to be a rate cut this year. I want to be very clear on that. And if so, when?
Yeah, I think so. But, the problem is the Fed is trying to walk a fine line because they don't want to admit how weak the economy is when President Obama is trying to elect Hillary Clinton based on the strength of the economy. And to cut rates is an admission from the Fed.
Right. So if they just don't
weak.
hike, they don't have to admit it, right?
Well, but the problem is if the markets are so weak, if the markets are really tanking, I think the only way to stop the decline is going to be with some type of rate cut. They're not going to be able to talk their way out of it. And so they don't want the markets crashing into the election either. So it all depends on where the markets are, whether or not we get the rate hike before the election or after. If the markets can still manage to stay within a few percentage points of their highs, then maybe the Fed could wait till after the election to have to do it. But I think we're in a recession right now, and there's a good chance that by the time we get the numbers on the second quarter, because we could have a negative first quarter, and the second quarter might be even weaker than the first. So if we find out by July, August that we're in a recession, and the election is a few months away, what is the Fed going to do? They may have to do something.
All right, Jim, Uriel, you think we're going a little bit higher from here? That's what the market's telling you. Come back at Peter.
Oh, no. Well, Peter, I actually, for 80% of what Peter says, I completely agree with. I think the market could go higher just based on global liquidity, not just the Fed. The place I draw the line, and I want to try to balance this with Peter, is when I hear you talk, to me it seems like you think it's 100% absolute and that you see not any one bright spot anywhere in the economy. Is that the case? Is there any one thing you can look at that helps validate your broader argument that says maybe that's strong, whether it be the consumer? You see nothing to write home about anywhere?
No, I think the economy in the U.S. is a disaster, and I think the Fed is one of the architects of that disaster. I'm not letting the administration off the hook. There's a lot of things that the President and Congress are doing to interfere with the economy, but the Fed has been a principal impediment to real economic growth because it hasn't allowed a legitimate restructuring. It's been blowing bubbles and preventing resources from being reallocated the way they need to be. Instead, the
Peter,
Fed is keeping all
the... If the Fed backed off now or backed off at any time in the last 6 or 7 years, there would have been an absolute implosion that we would have had to come back from. You believe that too, right? What else is the Fed supposed to do? Anytime they've backed off, wouldn't we have been in shambles?
Yes, but it would have been a healthy a process. We have to cleanse the economy of all the problems that have been built up. The Fed's cure is, well, just take more drugs, right? So you can stay high. You never have to deal with the underlying problems. But they keep getting worse. You mentioned the consumer earlier. The consumer is a mess. He's broke. He has a lousy job if he's even still in the labor force. Maybe he has 2 or 3 part-time jobs. He has no savings. He has no home equity because he's probably renting now. And he's buried under a pile of debt. And all of this is being kept together by the Fed. And it's just one big illusion. And everybody wants to point to these low unemployment rates as if it tells the real story. But it doesn't even tell a fraction of what's actually going on.
Peter.
If anything, it's, yeah.
Let me ask you this. Obviously, you've been a bear for quite some time now, and there are a lot of people on the street that agree with you. They're sort of just riding along with the market momentum. What's going to be the catalyst that makes the bearish thesis come true?
Well, remember, I haven't been a bear on the stock market. I've been a bear on the economy. I've been a bear on the dollar. Now, the dollar has risen over the past few years, although it just had its worst quarter in 5 years, and gold just had its best quarter in 30 years. So I think that the corner has been turned, and I think the air is coming out of this dollar bubble. But I think that my bearishness on the U.S. economy has been vindicated. I mean, look, this is the weakest recovery, if you want to call it a recovery, in history. So we haven't had the vibrant recovery that so many people were forecasting 4, 5, 6 years ago. So I think I'm already vindicated on the fact that this hasn't worked. And the only thing that you can point to is the low unemployment rate. But if you look at all the other economic data, we're getting data today that has never been this bad outside of a recession. And in many cases, this recovery for most people has been worse than a recession because the average American is poorer today than he was when the recovery began. He has a lower net worth, and his real wages have gone down.
There's no way to quantify, the rate of success or failure of the economy aside from the stock market, Peter, and the stock market is going higher.
Well, the stock market doesn't tell you anything. The stock market was going higher right up until the 2001 recession. Look how great the stock market was doing right before it went over a cliff.
And that brings me back to my central question then. What's the catalyst where the shoe drops?
Well, again, I think what the big catalyst is going to be is the recognition, the admission by the Fed that the economy is weak again or back in recession, and the Fed is going to have to cut rates. They're going to have to ignore the continuing increase in the consumer price index. So we're going to see rising inflation, a weakening economy. The Fed's going to be trying to stimulate. The bottom's going to drop out of the dollar. Then we're going to have a currency crisis. And then the Fed is going to be forced to raise rates to defend the dollar. And this whole house of cards is going to come tumbling down. And it's going to be a worse financial crisis than 2008. That is the end game.
Okay, let's talk about the dollar and the Fed's impact there, certainly boosting gold, as you mentioned. Gold's had a good run this year, up about 16%, a little bit of a pullback today on some dollar strength. Where's the next stop short term? Let's not talk 5,000 down the line. Let's talk about in the next month or two.
Well, remember, a few months back when gold was still well below 1,200, I said on your program that I thought when it got above 1,200, we would trigger some buying and we would quickly run up to 1,300. We didn't quite make it there. We got just above 1,280, and we're now consolidating the big run from 1,050 up to 1,280. I think we're in a trading range right now, 1,200 on the low side, 1,280 on the high side. This is normal consolidation after such a big move. What's so interesting to me is that none of the gold bears have really thrown in the towel. I mean, look at Goldman Sachs. They're just as sure that gold's going to collapse now as they were back in December. I haven't seen any major brokerage firms put any buy recommendations on any of these gold stocks, despite the fact that many have doubled or tripled this year. You know, they still have buys on financials that have had a horrible year, but nobody's recommending gold. So I still think we're climbing a wall of worry. I think it's early in this new bull market, which is really a continuation of the big bull market that began around 1999-2000. So I think once we break out of this consolidation, once we clear through 1,300, I think we can have a pretty quick move up to 1,400, 1,500. When exactly that's going to be, it's hard to say. But I think there's a lot of momentum to this move, and your fast money traders should be buying at the low end of this trading range.
Peter, what do you think Goldman's missing about the commodity rally that we've been experiencing?
Well, because they're still wedded to the old narrative. They still expect the Fed to raise rates 3 times this year. They still believe in this phony recovery. They still think the dollar is going to go up. And they're wrong. And, unfortunately, it's taking a lot for them to admit that. I think, at some point they're going to have to stop themselves out of these losing trades. I just don't know when. But I'm not in any hurry for Goldman to capitulate. The longer they stay short gold, the happier it's going to make me.
All right, one quick question before I let you go. Obviously, an election year, the markets are watching very closely. Are you supporting anyone in particular?
Well, I was a Rand Paul guy. He dropped out. So Ted Cruz is probably the closest ideologically to me. And I think if he had the nomination, I think he would probably be the best candidate the Republicans have nominated since Reagan as far as believing in the Constitution and believing in limited government. But I don't know. I might end up voting for Gary Johnson. He's probably going to be the Libertarian candidate again. I generally like to vote for what I like, not the lesser of two evils. So we'll see. Donald Trump, he says a lot of good stuff as far as identifying the problems. America isn't great, and we need to make it great again. He talks about the trade deficits. but those are a symptom of the problem. The problem is big government, regulation, taxes, the Fed. That's why we have these trade deficits. Tariffs are not going to solve them. They're going to make the problem worse. So Trump does a good job of pointing out a lot of the problems, but he doesn't have the right solutions.